If you've ever applied for an apartment and felt like you were applying for a loan, you're not imagining it. Somewhere along the way, renting turned into a credit exam. Today we're talking about how that happened, what we lost in the process, and what a fairer system could actually look like.
And we're going to rewind to a time that sounds almost unreal now. The old renting system before credit scores were a gatekeeper. Because the way people used to get housing tells you a lot about the choices we made, not just the progress we stumbled into.
So let's start there. Before credit scores became the all-purpose verdict on your responsibility, renting was messier, more human, and honestly more local. Landlords relied on things like personal references, word of mouth, employment letters, maybe a conversation at the kitchen table. In many places, the landlord might know your employer, your family, your neighborhood. That could be good, it could be terrible, but it was not a single number deciding everything.
And the key word you said is local. The risk assessment was basically social. It was built on relationships and reputations inside a community. If you were new to town, if you didn't have the right connections, you could be shut out. If you were part of a marginalized group, that same human judgment could mean discrimination with a smile.
Right. We shouldn't romanticize the old system. It wasn't some golden era of fairness. But it's worth noting what changed. We moved from subjective judgment by a person to an objective judgment by an institution. And that shift came with its own kind of prejudice, just packaged differently.
Which brings us to the rise of credit bureaus. People often think of credit reporting like it just kind of appeared because modern life needed it. But it grew because lenders wanted a standardized way to evaluate borrowers at scale. Once consumer credit expanded, businesses wanted a fast answer to a simple question. Will this person pay?
Credit bureaus turned that question into a product, a file about you, your history, your accounts, your payment patterns, and eventually, a score that compresses your financial life into a single signal. That score was designed for lending, but it didn't stay in its lane.
Because housing providers noticed something. Even if renting isn't a loan, the monthly payment feels loan-like. Regular, predictable, and non-negotiable. So they borrowed the tools of lending even when the relationship is fundamentally different. Renting is not building equity. Renting is not an investment vehicle for the tenant. But the screening system started treating the tenant like a borrower anyway.
And that's the moment landlords start to become risk managers. Not just people offering a unit in a building, but operators in a system where avoiding default becomes a central goal. Pricing, screening, security deposits, fees, late penalties, automated denials. It's a whole toolkit designed around minimizing loss.
To make that work at scale, you need metrics. You need boxes people can be sorted into quickly. That's where credit reports, background checks, eviction databases, income multipliers, and algorithmic screening come in. It's a shift from "can we work this out?" to "do you pass the filter?"
Let's name the big trend hiding underneath all of this: the mortgageification of renting. Renting starts to mimic mortgage underwriting. Think about what mortgage underwriting does. It tries to predict long-term repayment by looking at income, debt, credit history, and reserves. Then it enforces strict thresholds.
And now look at rental applications. Minimum credit score. Income must be 3 times the rent. No collections. No prior eviction. Sometimes even rules about how long you've been at your job. That's basically underwriting, but without the payoff the borrower gets in a mortgage, which is ownership.
Plus, with mortgages, there are regulations, disclosures, and rules about what can and can't be done. Renting has rules too, sure, but rental screening is often the shadowy world where a third-party report spits out an answer, and you may never know why you were rejected.
Which brings us to the power imbalance that made this possible. Because here's the thing, if you're a landlord and there are 10 applicants for one unit, you can demand anything you want. You can demand documentation, pay stubs, bank statements, a fee just to apply, a score, a cosigner, a guarantor, a larger deposit. The applicant is experiencing urgency. They need a place to live.
Housing isn't like buying a couch. You can't just wait for a sale if you're about to lose your current place. So the market gives landlords leverage, and the screening industry monetizes that leverage. Every extra checkpoint becomes normal, then expected, then mandatory.
And the narrative that justifies all of it is the myth of the good tenant.
Yes, let's unpack that. The good tenant is often described as someone responsible, stable, quiet, pays on time, doesn't cause damage, doesn't create conflict. Sounds reasonable. But when the industry tries to predict that person using proxies like credit score, it turns into something else. A preference for people who already have money, already have stability, already have a certain kind of paperwork life.
And it punishes people whose financial lives are complicated, even if they pay rent faithfully. If you had medical debt, if you went through a job loss, if you had a divorce, if you're coming out of an abusive situation, if you're young with a thin credit file, if you use cash or debit and don't build credit the right way, you can look risky on paper.
Meanwhile, credit score is not a tenant score. It was never designed to measure whether you'll be respectful, whether you'll maintain the unit, whether you'll communicate, or whether you'll treat neighbors well. It measures credit behavior in a credit system. And even within that system, it can reflect inequality, not just individual choice.
Here's a question. If someone has never missed rent in 5 years, but their credit is low because they had a pile of medical bills, are they a bad tenant? Most people listening would say no.
But the pipeline says yes, or at least not worth the trouble. And the trouble part matters. When landlords think like risk managers, the goal isn't to find a good tenant. It's to avoid the worst case scenario. That leads to blanket policies that eliminate nuance.
And then there's a weird circular logic. A person can't get approved because they don't have a strong credit history, but they can't build stability without housing. Or they get pushed into worse housing with higher costs, which makes it harder to pay bills, which hurts credit, which restricts housing options further.
It becomes a feedback loop, and the loop is profitable. The more barriers there are, the more people are forced into expensive alternatives. Paying extra deposits, getting a guarantor service, using rent now, pay later products, taking on high-interest debt to cover move-in costs.
So what would a fair system look like? Not a perfect system. Fairer. Let's build it from principles instead of habits.
Principle 1. Rental history should matter more than credit history. If the goal is to predict rent payment, then the strongest evidence is rent payment. Verified on-time rent over time should carry real weight, and it should be easy for tenants to access and present.
And not in a way that forces people into surveillance, either. We don't need a system where your bank account gets constantly monitored just so you can be trusted. It can be as simple as standardized landlord verification forms, or an opt-in registry where tenants control what's shared.
Principle 2. Make denials transparent and appealable. If you're rejected, you should get a clear reason that actually means something, not a vague, failed screening. And there should be a fair process to correct errors, explain circumstances, or offer alternatives.
Because errors are huge here. Wrong records, mixed files, old debts, eviction filings that never resulted in an eviction, background check mistakes. People can lose housing opportunities over data that's inaccurate or misleading.
Principle 3. Cap and regulate application fees, and require that screening is tied to a real available unit. Paying 5 fees because you're competing for 5 places is basically a tax on desperation.
Principle 4. Income rules should be realistic. The 3 times the rent standard sounds simple, but it ignores regional wages and rising rents. If nearly everyone fails the standard isn't responsible, it's exclusion.
A fairer approach would consider total obligations, household structure, and documented ability to pay, not just a blunt multiplier. And it would allow compensating factors like long rental history, savings, or consistent benefits income.
Principle 5. Reduce the penalty for being poor. That sounds obvious, but so many rental systems do the opposite. Large deposits, extra fees, and strict cutoffs create a world where the people least able to absorb shocks are asked to front the most money and prove the most.
Which is why alternatives like deposit caps, deposit insurance with strong consumer protections, or public programs that backstop deposits can matter. But they have to be designed so they don't turn into another predatory product.
And Principle 6. Acknowledge that housing is not just a market commodity. It's a foundation. When screening is too strict, the costs don't disappear. They show up as overcrowding, instability, homelessness, and stress that spills into health, school, and work.
So a fair system is one where risk is shared more reasonably, not dumped entirely onto tenants who have the least power. Some of that sharing can happen through policy, like stronger tenant protections and faster repair enforcement. Some can happen through public investment, like expanding affordable housing and supporting nonprofit housing providers.
And some can happen culturally, too, in how we talk about good tenants. Because that phrase can be a code word for easy tenants, meaning people who won't complain, won't request repairs, won't push back. A truly good tenant is just someone paying for a safe place to live and expecting the basic promises of housing to be kept.
And a truly good landlord, if we're going to use that language, isn't someone who perfects the filter. It's someone who provides safe housing, responds to issues, and treats tenants like customers with rights, not liabilities to be managed.
So here's the big takeaway. The credit score takeover of renting wasn't inevitable. It was a set of choices, driven by scaling, profit, and a belief that a number can replace judgment. But the number doesn't just measure risk. It also concentrates power.
If you're listening, you felt that power. If you've been rejected without explanation or asked to prove yourself over and over, you're not alone and you're not crazy. The system is built to be cautious on one side and urgent on the other.
And if we want it to be fairer, we don't just need better tips for renters. We need better rules, better transparency, and better assumptions about what people deserve before they've earned it.
Because housing shouldn't require you to already have a perfect life. It should be one of the things that makes a stable life possible.
That's our episode. Next time you're staring at an application asking for your entire financial biography, you'll at least know this is not the natural order of things. It's a system. And systems can be redesigned.